Hey everybody, this is Joe Massey with Castle and Cook Mortgage, and I am here today to talk about what do real estate agents need to know about lending in 1 hour. So we're here live on Facebook, on my Facebook business page, YouTube, LinkedIn. If you have questions, feel free to type them in the comment box. Would love to hear what questions you have as we go through this. Would love your comments, your feedback. Of course, this will be recorded. This will be on our website. It'll be on all of our social media pages, etc. So please feel free to comment with questions. Feel free to put comments in the chat box. Send me an email if you have questions afterwards, or if you happen to be watching this recording. Would love your feedback, your thoughts. And first off, a little bit about me. My name is Joe Massey. I'm with Castle and Cook Mortgage. I've been in the mortgage business for more than 20 years now. And one of the things that I really enjoy doing is talking with real estate agents and clients about mortgages. It's what I do all day, every day. Talk about loans at home, talk about loans when I'm out with my friends. I talk about loans, practically in my sleep. So love talking about this stuff and love educating folks, clients, consumers, real estate agents, anybody that is interested in the Denver market, in the real estate market in Colorado, or really wherever you're at. Everything I focus on is in Colorado. But all of the education that I provide is going to apply just about anywhere in the country, maybe anywhere in the world, depending on where you're at. Really important point. This is all for educational purposes only. I am not a real estate agent. I am a licensed mortgage loan officer, not giving out any sort of financial advice, not telling you what you should do, but just really sharing education to hopefully help you out there, real estate agents, with your clients that are watching and listening, hopefully helping you with questions that might come up. So let's go ahead and get started here. What we are going to talk about today is everything that a real estate agent or consumer would need to know about loans in 1 hour or less. Or I also call this loans from A to Z for real estate agents. So again, my name is Joe Massey with Castle and Cook Mortgage. Really appreciate all of you guys joining me today. Comments, questions, anything else you want to know, be sure to put that in the chat box, and I'll be sure to address those as we go along. So let's talk about what real estate agents want to know about mortgage lending. First off, mortgage lending is a really broad term. There's all sorts of things about mortgage finance. There's all different types of programs. There's all different types of qualifications. Every lender has their own rules, their own guidelines. Pardon me, their own guidelines. What we're going to talk about today is just the high level information that you need to know as a real estate agent. And my goal for this class is not to turn anybody out there into a loan officer. My goal is not for you to say, hey, you know what? I want to now become a loan officer. I want you to continue doing whatever it is you want to do, and don't try and become a loan officer, but know the common questions, know the common things that are going to come up in your real estate business. Or if you're a consumer, what are the common things that are going to come up when you're wanting to buy a house? I want you to know these high level topics, know some of the details, but if you really want to know more, call me. That's my job, is to answer the details, to help you get approved, to help your clients get approved, and be here as a resource for you. So let's dive in and talk about the first loan program that is one of the most common loan programs you're going to hear. And this is really simple. It's called a conventional loan. If you've heard of Fannie Mae or Freddie Mac, this is what they offer, are conventional loans. And some of the basics you're going to need to know. Number one, minimum down payment. This is a question that I get all the time. Joe, I don't have a lot of money saved up. Joe, I don't have 20% to purchase a new property. Well, if you're a first-time home buyer, that's what FTHB stands for. FTHB is a first-time home buyer. If you're a first-time home buyer, you can qualify for a new conventional loan with as little as 3% down. All right. So if you're buying a $300,000 home, you need as little as $9,000. Or maybe you want to buy a $500,000 home. Well, you would need $15,000 down as a minimum. All right. But maybe you're not a first-time home buyer. Maybe you've owned a home in the past, or maybe you are a first-time home buyer, but you've saved up more money. So the minimum down payment for the next tier is any primary residence buyer has to have at least 5% down. So if you've owned a home in the past, or maybe you've owned a property and sold it, and you have not owned a property for the last 3 years, you'd be considered a first-time home buyer. But if you have owned a property within the last 3 years, you would need to put down at least 5% for a primary residence. All right. Next one. What if you want to buy a second home? This is really popular in Colorado. We have a lot of folks that buy properties in the mountains, a lot of folks that buy properties for their children to live in when they're going to college. Second home is going to be anything, not the second property you're owning, but you've already got a primary residence and you're wanting to buy maybe a vacation property or a property for one of your children to live in for college. This would be a second home, and you need to have at least 10% down for that. All right. Next one is an investment property. All right. This is a really common misconception in the mortgage world. A lot of people think that you need at least 20%, sometimes even 25% down to buy an investment property. Well, if you're buying a single family residence, single family home, you can actually purchase an investment property with as little as 15% down. All right. Now, some lenders have this, some don't. This is something that we have here as one of our specialties at Castle & Cooke Mortgage is 15% down for a single family residence investment property. This is a great way to buy property if you're saying, you know what, Joe, I really want to get started in investing, but I don't have a ton of money saved up. Or maybe I'm taking some equity out of my primary residence and I want to buy my first investment property, and maybe I want to buy 2 or 3 properties. Well, 15% down can be a great option. Now, with 15% down, it's going to have a little bit of a slightly higher interest rate, slightly higher payment. You may not cash flow as well, which is a topic we'll talk about in a different video, but it allows you to purchase that property and get into the game of investing in real estate. Now, what if you want to buy a multi-unit property, a duplex, triplex, fourplex, something like that? Well, there you're going to need to have a little bit more money down, 25% down for a multi-unit investment. This is going to be usually for more experienced investors buying their second, third, fourth, fifth property. You can also purchase a multi-unit as a primary residence. I actually teach an entire class on that. It's similar to house hacking, where you're buying that first property with a really low down payment as your primary residence. So a little more in depth than we're going to go into today. But for investors out there, if you're thinking about getting a new conventional loan, you do need to have that minimum 25% down to purchase a multi-unit property. Now, interest rates. Conventional interest rates go up and down, just like all interest rates in the mortgage market. But conventional is usually going to be very, very low as compared to some other programs. But it does vary depending on your credit score, depending on your down payment, depending on the property type. All these different things are variables that go into determining your interest rate. Real common question that I get is people call me and say, hey, Joe, what's your rate today? Well, we don't have a rate. We have hundreds, dozens, thousands of different interest rates. It all depends. So let me ask you some questions, Mr. and Mrs. Client. What's your credit score? How much money are you putting down? What property type? Where is the property? There's lots of variables that go into determining that interest rate, but conventional is always going to be a great option to help you qualify for a very low interest rate. Now, the next one, I like to call it my favorite 4-letter word of the mortgage industry, mortgage insurance. A lot of folks really dislike mortgage insurance because they feel like they're paying an empty cost. Well, if you're putting down less than 20% on a conventional loan, you will have to have mortgage insurance. All right. Now, there's some different types of mortgage insurance. You can do monthly, upfront, or even lender paid mortgage insurance, but it really depends on what's the best option for you. The big benefit of mortgage insurance is it allows you to purchase a property without saving up that 20% down. So in the past, you wanted to buy a home, let's say in 1960, you had to save up 20% down. Then you would get the loan from your local bank. You would put down your 20% and they would move along. You would make your payments. And if something went wrong, the bank would foreclose on that property. Now that 20% equity, anytime a bank is foreclosing on a property, there's some costs associated with it. And oftentimes when they resell that property has lost money. And so that 20% down payment that you were required to make, that was the bank's protection that if you didn't make your payments, they were going to foreclose and be able to sell the property and have their loan repaid. Well, in the 1970s and 80s, mortgage insurance came along, and that was a way that buyers could purchase with less than 20% down. They said, all right, Mr. Banker, you can get insurance on this loan that if the client doesn't make their payments and they've put down less than 20%, you're still going to foreclose, but this insurance covers the bank's loss. The bank said, wow, that's a really neat idea. How much does it cost? Well, depends on a lot of the variables. Credit score, down payment, property type depends on a lot of different things. But here's the big benefit, Mr. Banker. Now you have more clients that can purchase properties because not as many people have 20% down. The bank said, hey, that's a really great idea, but Mr. Mortgage Insurance Company, we don't want to pay that $100 or $200 or $300 a month from our income. So how do we pay for this mortgage insurance? The mortgage insurance company said, hey, that's really simple. The client is going to pay it. If the buyer doesn't want to pay the mortgage insurance, they simply put 20% down. Or if they want to put less money down, the buyer pays that mortgage insurance. So it's ensuring the bank's loss, potential loss, but the benefit for you as a buyer, or the benefit for your clients, if you're a real estate agent, is it allows that buyer to not have to save up such a large down payment. And here's the really cool thing about mortgage insurance. It goes away on a conventional loan once you have that loan paid down to 20% equity or greater than 20% equity. So it will go away in the future. And if the value of the property goes up, you always have the opportunity to have the property appraised and refinanced to get rid of that mortgage insurance. So a lot of people don't like mortgage insurance, and I get that. I don't want to spend extra money I don't have to spend either, but it's important to understand the benefit of it, which allows that client to purchase the property without having to save up such a large down payment. Now let's talk about credit score. This is a big one. So the minimum credit score on a conventional loan is a 620. All right, so you do have to have that minimum 620 credit score in order to qualify for a conventional loan. However, remember up here we talked about credit score and down payment and property type. If you have a really low credit score, your interest rate increases. The cost of your mortgage insurance also increases. So one of the things that you'll see, and we study this quite a lot, if the client is below roughly a 660 credit score, conventional might not make sense. FHA might be a better alternative. And we're going to dive into that in the next slide. But it's important to understand, even if you don't have perfect credit, there's still options out there, right? Conventional can be a great option if you've got a 680, 700 credit score. You don't have to have that perfect 800 credit score to buy a property. Now, property types. You can buy a primary residence, a second home, or even an investment property with a new conventional loan. So if you're working in the investment community and working with a lot of investors buying, rental properties and multi-unit properties, conventional loans are something you really want to understand and really want to know about, because conventional is going to be the primary source of financing for investment property buyers. Conventional financing is also the primary source of financing for second home purchasers, someone buying a vacation home in the mountains, or someone buying a home for their children to live in while they're away at college. And then, of course, primary residence. This is a very large percentage of homes that are purchased in the United States are for primary residences. Now, property types. All right, there's a lot of different property types that buyers might be interested in. So conventional, you can buy a single family home. You can buy multi-unit, 2 to 4 homes, also townhomes, and also condos. All right, conventional has a lot of flexibility for the property type that the buyer can purchase. One really important point is condos. All right, there's a lot of miscommunication and a lot of conflicting information out there about condo financing. So condos, every lender is going to have their requirements that they're going to look at, and they're going to be looking at, is the homeowners association in good shape? Are there delinquencies? Are they collecting the dues? Are they involved in any litigation? So this is one that if you're focused on the condo market, I would encourage you to come to one of our condo classes where we talk about understanding homeowners associations, understanding the good, the bad, and the ugly about HOAs. And they're not all bad. In fact, most HOAs are really, really good. I own several properties myself that are involved in homeowners associations, and they can be a really great thing, but it's important to understand them. So make sure you join us for one of our future classes on condos and how to invest in condos and how to understand those homeowners associations to make sure you're getting good deals. So lots of different opportunities for the types of properties that you can buy with conventional financing. Now, the maximum loan amount for a single family home. All right, so this is a really cool number that's gone up just in the recent months here in the Denver metro area. So the maximum loan amount is $787,750 in the 7-county Denver metro area. It's a little higher in Boulder, so it varies by county. All right. But this allows you to purchase with as little as 3% down. So you could buy an maybe $815,000 home if you're a first time buyer with as little as 3% down. Now, if you're not a first time home buyer, you do have to have that 5% down, or you could put down even 10 or 20%, which allows you to buy bigger homes, but still qualify for these conventional loans, which are always going to be the easiest, well, second easiest to qualify for, and have really, really good interest rates. Other counties, most other counties in Colorado and in the US are going to have that maximum loan amount of $726,200. There's a few counties like Aspen County and Pitkin County and Summit County that are going to have higher loan amounts. But for the most part, most of Colorado is right around that $726,000 if you're outside of the Denver metro area. Now, another really cool thing with conventional is, and this is really popular right now, you can negotiate for the seller to pay closing costs. And on a 3 or 5% down program, the seller can pay up to 3% of the purchase price towards the buyer's closing costs. So whenever you're purchasing a property, you're going to have some costs associated with the transaction: title insurance, homeowners insurance, HOA transfer fees, the cost to process the loan, points if you decide to pay that, buy downs if you choose that, which is a whole different class. We'll get into at a later date. But you can negotiate for the seller to pay those costs and really minimize the amount of money that buyer is having to bring to the closing. If you're an investor buyer or you have clients that are investors, you can get up to 2% of that purchase price that can be used towards the buyer's closing costs. And here's a really cool thing. If you're a primary resident and you're putting down greater than 10%, which we are seeing some people put down more money right now, you can have the seller pay up to 6% of the value of the property. All right. This can go towards buying down the interest rate, towards paying title insurance, homeowners insurance, any of the costs associated, but you do have to be putting down at least 10% in order for the seller to pay up to 6%. So it doesn't happen all the time, but sometimes does. But it is a good little nuance to understand. But for the most part, since we're talking about the high level and important things that agents want to know, you really want to focus on that 3% maximum seller concession or up to 2% maximum seller concession for investment properties. Now, closing timeline. So the average contract that I see is 28 days. All right. Most folks write a 21 to 30 to 35 day contract. And that is more than enough time for us to get an appraisal process and underwrite a conventional loan. But we also offer a closing service as fast as 8 days. This is our rush closing service, which can be a really powerful negotiating tool if you're looking at buying a new property and maybe there's competing offers. Maybe there's 3 other offers and all of those offers are going to take 30 days. And you say, hey, you know what? We're going to offer you the same price, but we'll close in 10 days or 15 days. All right. Our 8-day closing rush service is the fastest permitted by law. All right. So the way it works, when you apply for your loan, there's a 7-day cooling off period before you can close. So we will close your loan on that 8th day. It's a unique service that we offer here at Castle & Cooke Mortgage. And it's something that a lot of our buyers use to separate their offer versus other offers in the market. So make sure you reach out to me if you have questions or if your clients want to use that service. It's a great, great way for you to compete with other buyers. I know right now there's not a ton of buyer competition, but it won't be long before the market shifts a little bit and there'll be a lot more buyer competition. So keep that in the back of your mind. That's a service that we can help you with. So big benefits of conventional loan. Number one, really low mortgage insurance. I'm going to show you some comparisons on FHA and some other programs. Conventional will always have really reasonable mortgage insurance. However, it can change depending on that credit score, how much money you're putting down. And you also have the option to put down more money and completely eliminate that mortgage insurance. If you don't want to pay mortgage insurance, put that 20% down and you do not have to pay that. You also have flexibility for different ownership types. All right, this is really nice that on conventional, you can buy, you can buy a primary residence, you could buy a second home, you could even buy and finance an investment property. So lots of benefits on a conventional loan for how you can best finance that property. But there's some downsides. Number one, interest rates are going to vary significantly depending on your credit score, the property type, the ownership, the amount of down payment, etc. So there can be some variables. Again, it goes back to what I mentioned earlier. A lot of times people say, hey, Joe, what's your rate today? Well, there's a lot of things that go into that, Mr. and Mrs. Client. It really depends a lot on you. If you have great credit, yes, you're certainly going to qualify for the lowest possible interest rate. But maybe you're buying an investment property. So it might be a slightly higher interest rate versus somebody who's buying a primary residence or maybe a second home. So lots of variables go into that. But conventional is going to account for roughly 75% of your transactions over your career. Some people work a lot with investors and they only do conventional loans. Other folks work a lot with the military and they do a lot of VA financing. So it really just depends, right? But approximately 75% of your transactions over your career are going to be conventional loans. So I'd encourage you, save this slide, save this this video for questions on conventional loans. Want you to have these high-level details so you can answer your clients' questions. So if you're just joining us, I saw a few people joined here online. We are talking about everything that an agent needs to know about lending in 1 hour. Again, my name is Joe Massey with Castle & Cook Mortgage, and we're covering the high-level details of what an agent needs to know about loans. There's lots of information out there, some really good information, some really bad information, but most notably, a lot of really confusing information. So I like to dispel those rumors, dispel those myths, and share great information about really what it takes to qualify for new mortgage financing. If you have any questions, if you have any comments, if you disagree with anything, please type it in the chat box. Definitely want to hear your feedback. All right, let's talk about our next loan program, FHA. This stands for the Federal Housing Administration. All right, this is a very popular loan program for first-time buyers, although you do not have to be a first-time buyer to use FHA financing. Let me repeat that. FHA is for first-time buyers as well as non-first-time buyers. That's one of the most common misconceptions out there. You do not have to be a first-time home buyer to use FHA. All right. Big benefit of big benefit of FHA, minimum 3.5% down. All right. So if you're buying a $300,000 home, this would be $10,500. All right. So it's a little bit more than that conventional minimum loan amount of 3%. But remember that conventional minimum down payment of 3% is only for first-time buyers. So maybe you've owned a home in the past, maybe you sold it, you're buying another property. FHA can be a great option to really minimize that total investment. Now, these funds can come from a number of different places: your checking account, savings account, stocks, bonds. You can also do gift funds. This is a really popular one. We see this a lot with younger buyers that they've graduated from college, they've got a really good job, they're making good money, but they don't have an opportunity to save up for a down payment. Rent has gotten really expensive. Cost of living is really expensive. It can be difficult for young people to save up that down payment. So mom and dad, brother, sister, aunt, uncle, grandma, grandpa, just about anybody in the family can help these buyers with gift funds. And it doesn't have to be young people. It can be people that, maybe they're 35 years old and, they just haven't had an opportunity to save up. Or maybe they're, I've actually seen this where mom and dad sold a property, unfortunately had some tough times, didn't get a lot of equity out of it, and their children provided them with a gift to help mom and dad buy their next property. So gift funds can come from various different sources. Just about anybody in your family can help you with those gift funds. It can be a great, great way for somebody to purchase that property. Now, another really popular thing I get a lot of questions about: down payment assistance. All right. So maybe you don't have a family member that can help you with a gift, but are there other folks? Are there other programs out there to help you with down payment assistance? Yes, absolutely. We have a number of these here at Castle & Cook Mortgage that allow you to put down as little as $1,000. So it does not require a really large down payment. And this can be in the form of a grant or a second mortgage. All right. So these programs are terrific. There are some restrictions. Some of these, if you make a lot of money, you may be over the income limit. However, we do have some down payment assistance programs that have very few restrictions. One of our most popular does not have any type of income restrictions. So we'll talk about those in future videos. If you want to learn more about those, certainly reach out or put notes in the chat. I'd be happy to comment on those. But the most important thing you want to understand is as you're talking with your clients, they might say, you know what? I don't have a lot of money saved up. Well, how much do you have? Well, I've saved up about $5,000. Great. Let's get you in touch with Joe. He's my lender. He'll talk with you about some of their down payment assistance programs. All right. FHA. This is another one we spoke about earlier with conventional. Interest rates on FHA are always the lowest available. So FHA is a government-backed program. With that government guarantee or that government insurance really allows lenders like myself to offer the lowest available interest rates on FHA loans. However, there comes a trade-off. You will have mortgage insurance. Yes, if you do an FHA loan, you will have mortgage insurance, and it's going to come in two ways. It's going to be upfront, which is financed into the loan, and it will also be monthly. So you will have mortgage insurance on an FHA loan. And a lot of people ask me, you know what, Joe, I want to put 20% down, so I'm not going to have mortgage insurance on my FHA loan. That doesn't work. FHA loans have that FHA mortgage insurance guarantee, so you will have mortgage insurance on an FHA loan, regardless of how much money you put down. So that's a real common misconception that folks get FHA and conventional confused, and they don't realize that it's two totally different loan programs. If you put down 20% on a conventional loan, correct, no mortgage insurance. If you put down 20% on an FHA loan, you will still have mortgage insurance. Now, sometimes it still makes sense to do. It's a big part of what we do with every client as we look at their overall situation and really counsel them on here's the various types of loans that you can get, the various routes, and figure out what is best for you, Mr. and Mrs. Client. Now, minimum credit score. You'll remember on conventional, you could go down as low as a 620 credit score. But on FHA, allows you to go even lower, down to a 580 credit score with that minimum 3.5% down. And I actually need to update my slides because we now will go below a 580 credit score. However, you do have to have a little bit more money down. You have to have at least 10% down if you're going below that 580 credit score. So even if you're below that 580 and you're interested in buying a home, give us a call, or you have clients that are interested, but they're nervous. We want to chat with them. You know, maybe they can qualify right now for FHA, or maybe they've got to work on a handful of things. It really just depends, but it's important that we chat with them and give them all of the great information that they need for their individual scenario. Now, what type of properties or what type of buyers? This is for primary residence only. You'll remember you don't have to be a first-time buyer to use an FHA loan, but you do have to be buying a primary residence. So a real common question I get is folks call me and say, hey, Joe, I want to buy a new property. I want to buy an investment property. I'm going to rent it out, but I want to do that FHA 3.5% down plan because I don't have a lot of money to invest. Well, that's great. I understand that. But we got to talk through, if you're not going to be living in the property, you cannot use FHA financing. However, if you're going to be purchasing it as a property that you're going to live in, absolutely, we can help you with an FHA loan. So we talk through and really go through the buyer's goals and what they're really looking to achieve. Maybe FHA is right and they are going to live in that property, or maybe they're going to use a conventional loan and buy a new investment property. Really just depends. Depends on what is best for their individual situation. Now, the next one, property types. So you can purchase a single family home, a 2 to 4 unit property, a townhome, or a condo. Now, a real common question that I get, which I haven't seen anybody type it in the chat box yet, but Joe, you just said we can only use an FHA loan for a primary residence. How can I buy a 2 to 4 unit? Isn't that by definition an investment property? Yes, it is an investment property, but if you're living in one of those units, it now qualifies as your primary residence. So a really popular thing that we'll see is maybe a young person or a single person wants to get started in property investing, and they'll buy a duplex as their first property. And they're going to live in unit A and they're going to rent out unit B. Well, it's going to be a little bit of a higher price because you're buying 2 units, but with that rental income on unit B, that'll offset a portion of their mortgage payment and make it much more reasonable and much more affordable for them to own that property. So that can be a great way for beginning investors, is by moving into that multi-unit property. Now, condos, there's a note here. Condos must be on the FHA approved list. So I see a lot of misconceptions and a lot of misinformation out there about this. So you go in the MLS, you look at a property and it's checked FHA approved. You go look at it, your buyer falls in love with it. They're like, this is terrific. I absolutely want to buy this. You get it under contract. Buyer calls me, okay, Joe, I'm ready to buy 123 Main Street. Here's my FHA contract or my contract, and it's checked FHA financing. I pull it up and that condo is not on the FHA approved list. That's a problem. Condos, if you want to use FHA financing, do need to be on the FHA approved list. Now, there are some things that we can do with spot approvals, meaning that if it's not on the list, we can work with the homeowners association, gather information, and get a single unit approved. But by and large, if the property and the HOA is not already on the FHA approved list, does not make sense to show that to FHA buyers because there's likely some reason why that project has not been approved by the FHA. But the most common reason is because the homeowners association hasn't sent in the paperwork. That's the most common reason for an HOA to not be on the FHA approved list. But to make your life easier, agents out there and clients out there, when you're looking at properties, make sure they are on that condo approved list, FHA approved list, if you're looking at condos. All right, and that's, I mentioned earlier, we teach a full condo class that we get into that really, really in depth. That'll be upcoming on another Facebook and YouTube and LinkedIn Live. So you guys tune in for that in the future. Maximum loan amount. All right, this is similar to conventional. This has recently increased. Here in the Denver metro area, you can get an FHA loan for up to $787,000. That allows a buyer to purchase about an $815,000 property with just that minimum 3.5% down. So it really allows people to purchase with not a ton of investment. If you're in El Paso County, Colorado Springs area, you can purchase up to a $517,000 loan amount. Now, maybe you're buying a $550,000 or $560,000 home. You can still use an FHA loan. You just have to put down the difference between that purchase price and that maximum loan amount. And most other counties in Colorado have the $472,000 limit. Again, there's some counties, Summit County, Pitkin County, I believe Garfield County might be a little bit different. Some other counties will have some various maximum loan amounts, but for the most part, $472,000. Now, seller paid closing costs. This is really cool. With FHA, even with that minimum down payment, you can have the seller contribute up to 6% towards the buyer's closing costs. This would cover virtually all dollars associated with buying the property. Title insurance, homeowner's insurance, appraisal, processing costs, underwriting costs, HOA transfer fees, points if you opt to pay that, buy down costs if you opt to pay that. By negotiating for the seller to pay those closing costs, the buyer can truly walk in with very, very little money out of their pocket, really just that minimum 3.5% down. And how long does it take to close? Well, the average, 28 days. We see most of our clients write a 30-day contract, sometimes a 21-day contract. Sometimes they write a 35-day contract if they need a little bit more time. But for FHA, we also offer our priority 8-day rush service. All right, this is a service that we offer here at Castle & Cooke Mortgage, which allows your offer to stand out from other offers. Kind of back to my scenario earlier, let's say there's 3 offers on a property, and all 3 of these offers are going to close in 30 days, 25 days, and 35 days. You show up and say, hey, I'm going to offer you the same list price as everybody else, but I'm going to close my transaction in 10 days. Mr. or Mrs. Seller, is that beneficial for you if you get your cash sooner and this property is sold sooner? Yes, that is very beneficial. That is a great way that agents out there and clients out there can negotiate and win in competitive situations. So reach out if you want to learn more about that. That's a service that we've offered here at Castle & Cooke for more than a decade and has worked hundreds of times in order to help clients purchase properties and win in competing situations. So big benefits of FHA. Number one, really low down payment. All right. Super low interest rates. It's easier to qualify. All right. FHA is going to be the easiest loan to qualify for. Again, it's got that lower minimum credit score, lots of flexibility if you have things like second jobs, if you've got gift funds, if you've got down payment assistance. FHA is by far the easiest loan program to qualify for. However, it is going to have upfront and monthly mortgage insurance. And even with that lower interest rate, the total payment might be higher than a conventional loan because the mortgage insurance might be more expensive on FHA and because you're putting less money down. So a lot of times people say, you know what, Joe, I want the lowest rate and the best program. Well, I completely understand that, but we've got to look at your scenario, Mr. and Mrs. Client, to understand which one is the best for you. And maybe this one has a lower rate, but it has a higher payment. All right. So are you concerned about the interest rate or are you concerned about the monthly payment? And that's a conversation we have with all of our clients to really find out what's most important for them to have a great experience in purchasing a property and to have the right loan for that property over the long term. Now, FHA is going to account for roughly 13% of your transactions over your career. If you do a lot of work with first-time home buyers or you do a lot of work with folks that don't have a large down payment, FHA could be a higher percentage of your transactions. But on average, we see agents close roughly 13% of their transactions are FHA transactions. All right. For those of you joining us, my name is Joe Massey with Castle & Cooke Mortgage, and we're talking today about everything an agent needs to know about lending in 1 hour or less. So this is for newer agents, experienced agents that are looking to brush up on their skills, or even clients that just want to learn about the mortgage business and about financing. All right. There is miles and miles and thousands of reams of paper and internet articles and all sorts of things that you can Google about mortgage lending. Tons of great information out there, tons of bad information out there, tons of confusing information out there. So the big thing that I'm focusing on today is just the high level and important information that an agent and or client need to know in order to have the skills to purchase a new property and make sure that they are getting a great mortgage for that new home. So moving along, let's talk about jumbo financing. So jumbo is going to be something, it's not going to apply to a ton of people because it's obviously bigger homes, bigger loan amounts, etc. But what are the things you want to know? Number one, if you're buying a primary residence, you've got to have at least 10% down. When you're buying a bigger property, you've got to have a little bit more money to invest. Excuse me. If you're buying a second home, property up in the mountains, 15% down for second home properties. Or maybe you're buying a really large investment property, 30% down. All right. When you're buying larger properties, you generally have to have larger down payments. And the other important point is interest rates are often going to be about 0.5% higher than a conventional loan. Could be a little more or a little less, depending on your credit score, the amount of money you're putting down, your property type, etc. But one really cool thing about jumbo, no mortgage insurance required. All right. The loan programs that we have here, you are not required to have mortgage insurance on a jumbo loan, even if you're putting down less than 10% on a primary or second home. You're not required to have mortgage insurance on a jumbo loan, but you are required to have a better credit score. All right. You do have to have that 720 credit score or higher. And if you really want to qualify for the very best jumbo interest rates, you really want to have a 780 credit score or higher. If you don't, you're at a 760 or 740, that's okay, but it might be just a slightly higher interest rate. And ownership types, you can use a jumbo loan to purchase a primary residence, a second home, or an investment property. You can also purchase single family homes, 2 to 4 units, townhomes, and condos. The requirements on these are going to be really, really similar to conventional. The big difference is this is the conventional loan amount plus $1. So if it doesn't qualify for a conventional loan and you've got to do a jumbo loan, this is what you're looking at, up to roughly $2.5 million. There's some options to get loans larger than that. Doesn't often apply because oftentimes people purchasing really, really large homes are oftentimes putting a very large amount of money down. And you can have the seller, very similar to conventional, contribute up to 3% of the purchase price towards the buyer's closing costs. And if it's an investment property, up to 2% of the purchase price. And average closing for a jumbo property is about 30 days. very similar to what we see on conventional and FHA. It does take roughly 30 days for most contracts. However, we offer our priority rush service on jumbo as fast as 14 days. We can't quite do our 8-day closing on a jumbo transaction simply because it does take a little bit longer to get an appraisal on a jumbo loan. Now, we had a really great question here. Let me go ahead and share this so that everybody can see it. Can you buy down the interest rate? Can you buy down your interest rate on a jumbo loan? Yes, you certainly can. And so there's a couple of things that you can do. You can, number one, spend more money in closing costs to buy down your rate, or you can have the seller contribute towards the closing costs, and that will buy down the rate as well. So when you get those seller paid closing costs, you can use that to pay title insurance. You can use it to pay processing costs, appraisal, any of the costs associated with the transaction, including buying down to a lower interest rate. So great question there, Eric. Thank you so very much for that. All right, let's talk about the big benefits of jumbo. This allows you to buy larger properties, kind of a no-brainer there. You also have the opportunity to get fixed rates and flexibility for different ownership types. Again, you can buy a primary residence, second homes, investment properties, just about anything out there. The downsides, you're going to have a slightly higher interest rate as compared to a conventional loan, and your rates are going to vary significantly based on credit score, property type, ownership, down payment, etc. So again, it kind of goes back to what we've discussed in the past. It's not as simple as, hey, Joe, what's your interest rate today? Really depends on your individual qualifications. We have great rates, just like a lot of lenders out there, but what do you, Mr. and Mrs. Client, qualify for so that we can get you the best possible loan? So jumbo transactions are going to account for about 2% of your transactions. Reason being is there's not a lot of people that can afford $1 million, $1.5 million, $2 million home. However, if you work in Red Rocks Country Club or you do a lot of work in Wash Park, your personal percentage might be greater than 2% of your entire business being jumbo transactions. It really just depends. But as a whole, we see jumbo account for roughly 2% of the transactions for the average real estate agent. Okay, if you're just joining us again, my name is Joe Massey with Castle & Cook Mortgage. And what we were talking about today is everything that a real estate agent or client needs to know about lending in 1 hour. So really covering the high levels of what's important to understand. There's a lot of information out there on the internet, articles, blogs, all over the place, lots of great information, lots of outdated information, lots of bad information. So what we're talking about is what you need to know to really know the high level details, the high important information in order for you to speak openly with your clients and understand the details of what's going on. This is not about trying to turn anybody into a loan officer or give you every single nuance. That's my job to know all of the nuances, but I want to give out that good information so that you can have some understanding, be able to answer some of the basic questions. And when your client gets really into the details, you can say, you know what, Mr. and Mrs. Client, that's a great question. Let's call Joe over at Castle & Cook. He'll be happy to help with that question. Let's move along here and talk about VA. This is by far my favorite loan program. This is by far the best financing available in the United States. However, it's not for everybody. You must be an active military member or an honorably or general discharge veteran. So VA stands for the Veterans Administration, and it is for folks that have served in the armed forces, Air Force, Army, Marines, Navy, Coast Guard. If you served in the armed forces, you likely qualify for VA unless you were dishonorably discharged. But assuming you were honorably discharged, general discharged, or you're still active, VA is a great way that you can purchase a property with zero money down. All right. That's the really cool thing about VA is this benefit allows you to put no money down. And interest rates are always the lowest available. All right. VA has the lowest available interest rates and also very cool, no mortgage insurance. All right. So think about that for a minute. If you served in the military, you want to buy your first property, you haven't saved up a lot of money, but you say, you know what, I want to buy a property. Boy, I really uncomfortable paying $100, $200, maybe $300 a month in mortgage insurance. VA is going to be a perfect option for you. Allows you to purchase no money down, no mortgage insurance, and a super low interest rate. If you are in the military, please, please, please make sure you are taking advantage of this benefit. However, there is a cost, which is the VA funding fee that's paid to the VA, and it is included in the loan. And if it's the first time you're using your VA benefits, it will be 2.3%. If you have used your benefits in the past, it could be as high as 3.6%. Now, that can be less if you're putting a larger down payment, but if you're doing the no money down program. But here's the neat thing. If you are a disabled veteran, that funding fee is completely waived. So if you receive any type of VA disability benefits, you would not have to pay that VA funding fee. And minimum credit score, down to a 580, which is kind of cool. You do not have to have perfect credit if you're a veteran and you want to buy a new property. So if you're out there and you're thinking, boy, I'd really like to buy a property, but I don't have 20% down, I don't have perfect credit, you know what? VA might be a really good option if you served in the military. However, this is for primary residence buyers only. All right. It's not for purchasing investment properties. It's not for purchasing second homes. It's really for veterans to utilize this benefit to provide housing for themselves and their family. And you can buy a single family home, 2 to 4 unit, townhome, or condo. But remember, back from FHA, VA is very similar that the condo must be on the approved list. Here's kind of an interesting thing, not the same list. All right. So if you're looking at VA condos, you want to go to that website right there and double check when you're looking at the property that condo is, VA approved. All right. Because you don't want to fall in love with the property, get it under contract, then find out that it's not VA approved. Great way to experience heartbreak in the mortgage business and the real estate business. So we hear about that. So make sure you're double checking that condo approval list if you're interested in purchasing a new condo with a VA loan. One other really cool thing about VA recently changed. There is no maximum loan amount on VA. You could buy a $2 million home, assuming you can afford the payments. You could buy a $2 million home with no money down, no mortgage insurance, and a 30-year fixed rate. Pretty cool if you think about that. And you could even get the seller to contribute up to 4% of the purchase price towards your closing costs. This would cover your appraisal, title insurance, homeowners insurance. It can also cover the VA funding fee. All right. So you can, if you're not a disabled veteran and you do have to pay that, you can negotiate for the seller to pay that for you. All right. Lots of great benefits on using VA. Only one downside, does take just a little bit longer to close. On our priority rush service on FHA and VA and jumbo, we do have to pay a little bit additional to rush the appraisal. That is not an option on VA. So when you do a VA transaction, we've closed these as quickly as 2 weeks, but the average is that 30-day time frame. So big benefits on VA, no monthly mortgage insurance, the ability to put no money down, very low rates, and very easy qualifications for veterans. However, it's not for everybody. All right. I did not serve in the military. I don't qualify for this. All right. You have to have been either active in the military or a qualified veteran. So not everybody's going to qualify for this. And that one other downside, the loan is going to have that VA funding fee added into the loan unless the client is a disabled veteran. But by and large, VA is by far the best loan program out there, by far the best way to purchase a property with the lowest amount of cash out of pocket, lowest monthly cost. So if you served in the military, please make sure you hang on to your DD-214, which is your paperwork from when you got discharged, because it will be critical that you take a look at these VA benefits when it's time to purchase a property. So on average, this is going to account for about 5% of your transactions. Why 5%? Roughly 5% of the United States population served in the military. Some years it's more, some years it's less, but approximately 5% of the population served in the military. So for the average real estate agent, approximately 5% of your transactions are going to be VA. But maybe you're a veteran and you network a lot at the VFW, or you've networked a lot with other veterans. Maybe your individual percentage could be very high. I've one real estate agent that I work with. I think he does 100% of his transactions are with veterans and VA loans. Outstanding. All right. But on average, this is going to account for about 5% of your transactions. So if you're just joining us, Again, my name is Joe Massey with Castle and Cook Mortgage. We are talking today about everything a real estate agent needs to know about lending in 1 hour or less. This is really to give you the high level information about what's happening in the mortgage world, terms and terminology that you need to know, not to try and turn you into a mortgage expert, but to make sure that you've got the information that you need to speak openly and be educated and have conversations with your clients. And then when they really want to get into the details of how do mortgages work, what do they qualify for, that's when you give me a phone call. We're always here and always happy to help. All right, let's talk about our last loan program, USDA. So the property must be in a qualifying rural development area. When I hear the term USDA, I think about the United States Department of Agriculture, and that's what this is. You think about, corn and steak and food and all the things that the USDA does. Well, they also have a loan program, and it is for qualifying rural development areas, and it's for people buying a single-family home in these qualifying areas. And they have a really cool search tool. You go to this website here, and it'll bring up the entire United States. And you type in an address and it'll zoom in and it'll tell you, yes, this is eligible, or no, this is not eligible. So I took a copy of this map and I've put it over here on the right. And what you'll see is the areas that are in red are not eligible. These are the ineligible areas. But what do you notice about the rest of this map of Colorado? A very, very large percentage of Colorado is eligible for USDA financing. So if you've got somebody out here in Lyman, Fort Morgan, Sterling, maybe out here in Craig, Colorado, Montrose, Gunnison. If you've got clients in these areas that are thinking about buying properties, USDA can be a great, great option for them. Big benefit of USDA, no money down. All right. It's a government program that allows them to purchase with no money down, and interest rates super low, same as FHA and always the lowest available. However, it does require mortgage insurance, but it is reduced mortgage insurance. It's similar to FHA in that it is upfront and monthly, but it's less than half of what you pay on a monthly basis for an FHA loan, or pardon me, for a USDA loan compared to FHA. And we'll go down to that minimum 580 credit score. Just like FHA, it is for primary residence buyers only. And property types, you can use USDA for single family or for townhomes. There is no maximum loan amount. However, the buyer is subject to maximum income limits. All right. And this varies by county. And so when you do this search up here, it's going to give you information about the county and information about maximum income limits. So if you have somebody that makes $300,000 and wants to buy a property in Trinidad, USDA is probably not for them, because this is for qualifying rural development areas for low to moderate income earners. So it's a government program to help these developing areas. It's not necessarily to help somebody that has saved up a ton or makes a ton of money. It's really to help those low to moderate income earners in these rural areas. So there are some restrictions, but still a really, really great option. And the seller can contribute up to 6% as seller paid closing costs. And the average timeline, roughly 30 days. All right. The difference there is it does take a little bit longer generally to get an appraisal in a rural area. So there's not as many appraisers there, can take just a little bit longer. Transactions sometimes take a little longer. So the average closing we see on USDA transactions is 30 days. So big benefits, no money down, no mortgage insurance, low interest rates. However, you've got to be below those maximum income guidelines and you must be in a qualifying area. And the loan is going to have that USDA funding fee, or also known as upfront mortgage insurance, added to the loan amount. So a real common question that I'll get, hey, Joe, I'm wanting to buy this property right here in Denver, and I want to use USDA. Unfortunately, Mr. and Mrs. Client, that property is not in a USDA qualifying area. Let's talk about FHA, or let's talk about some other options. But if you're out here in Lamar, you want to buy a property using very low money down, outstanding. USDA could be a great option. Or Glenwood Springs, right? Any of these areas that are not highlighted in red, not the areas I've circled, but the areas that are not highlighted in red can be great options for you to use USDA financing. Now, for real estate agents out there, this is going to account for approximately 5% of your transactions. Now, that's true if you're here in the Denver metro area or if you are in a ineligible area like Denver metro. But maybe you live here in Gunnison and you work a lot in that area. USDA could account for 50, 60, 70% of your transactions. We have a couple of branches in Nebraska, and USDA is a very, very large percentage of their business. So it really just depends on where you're at. But overall, we see that USDA accounts for about 5% of transactions, but that can be higher or lower depending on the areas that you work in. All right, if you're just joining us, my name is Joe Massey with Castle & Cook Mortgage, and what we're talking about today is everything an agent needs to know about lending in 1 hour. If you have questions, make sure you put them in the chat box. Questions, comments, if you want to learn more about something. If you disagree with something, sometimes those are my favorite comments. I want to hear what you think and what your thoughts are. We are getting close to wrapping up here, and I want to cover just a couple of important points that are really, really critical that you should know. First off, I want to talk about the difference between being pre-qualified versus being pre-approved. As I mentioned earlier, there's a lot of information out there on the internet, lots of articles, lots of blogs, lots of videos, lots of social media postings, all sorts of things out there. And this is a real common one, pre-qualification versus pre-approval. So pre-qualification, client gives us a phone call, we gather some information. Where do you live? Where do you work? How much money do you make? Let's take a look at your credit score. Tell me about your spouse's information. Where do they live? Where do they work, etc. Then based on that credit report, based on their verbal information, we provide them with that pre-qualification letter. So the credit report, we can see that, and they say, hey, I make $75,000 a year, and I have $50,000 in the bank for my down payment. Terrific. Here's your pre-qualification. Now, Mr. and Mrs. Client, we're going to ask you for some information. 2 paycheck stubs, 2 most recent bank statements, 2 years most recent W-2s and tax returns, copies of any divorce decrees, bankruptcy paperwork, foreclosure paperwork, anything that might have applied in the past. If you're retired, we're going to ask for your Social Security information or your pension information. We're going to ask for the name and phone number of your real estate agent so we can communicate with them. If you own any other properties, we're going to ask you for copies of those mortgage statements. Once the client sends all of that information into us, at that point, we're going to completely underwrite that loan. So verbally, they told us they make $75,000 and they've got $50,000 in the bank. Now we receive the information. We go through the paycheck stubs. They actually make $77,000. We go through the bank statements. They actually have $56,000 in the bank. That's going to allow us to really have that written information that we can then underwrite the loan and give them that pre-approval that we have verified all of that information that they've provided us. Okay. So that's really, really an important step. I see this happen a lot where somebody is pre-qualified. They go out, they look at homes, they get under contract. Then at a later date, they provide the written information to the lender, and it's not exactly what they thought. And all of a sudden you have problems. So this is something that's different that we do it here at Castle & Cook Mortgage. We're going to ask the client for all of that written information, credit, paycheck stubs, tax returns, W-2s, bank statements. That way we can truly say, Mr. and Mrs. Client, this is your pre-approval. Your loan is underwritten. You are ready to go look at homes, write an offer, and know that you are going to close on that transaction. So agents out there, really, really critical to make sure that your clients are getting fully pre-approved, ideally with us as we do all of our underwriting up front, so you know that pre-approval is valid. Here's a really interesting point. An industry average, 72% of pre-approved clients are actually approved for their loan. 28% are turned down by their lender at a later date. So think about that for a minute. 72% of people receive a pre-approval and move forward and close on that transaction. 28% of those people receive a pre-approval and then get turned down by the lender at some later date. Here at Castle & Cook Mortgage on Team Massey, we have a 100% track record, meaning if we have given you a pre-approval, 100% of our clients have closed on their transaction. All right. Now, there may be problems with the property and they say, hey, we don't want to buy the property because of XYZ reason, but we have never once turned down a pre-approved client based on their loan. The reason is we ask for that information up front. please send us your paycheck stubs, your tax returns, your W-2s, so that we can really, really underwrite and provide really solid information to that client. So that's a big distinction that people don't realize is you might have a pre-approval from XYZ company. There's a 28% chance that that pre-approval is not actually valid. And I've seen that happen with clients where they'll call and, holy cow, I thought we were pre-approved. They said we were good to go. And all of a sudden we're not. Joe, can you fix this? Yes, let me look at it. Oftentimes we can fix it. Sometimes we cannot. And that pre-approval letter truly was invalid. So please, agents out there, make sure you're talking with a lender. Make sure you're understanding your lender's guidelines. Make sure you're understanding your lender's track records, that pre-approval really is solid. That's one of the things we really pride ourselves on here at Castle & Cook Mortgage. All right. This is a real common one. Joe, I want to buy a house, but I don't want my credit score. I don't want my credit pulled because my score will go down. Okay. If you're out there and you're thinking this, and this is really common, it's important to understand that the average decrease on your credit score when you have your credit report pulled is 1 point. All right. So a common question that I ask clients, Mr. and Mrs. Client, if the decrease of 1 point on your credit score is what is going to prevent you from qualifying, then we likely have bigger issues. Are there any other items that are preventing you from speaking to my lender? So that's a real common thing that real estate agents will say. The client doesn't want their credit report pulled because they don't want their score to go down. Okay, I get that. All right. Everybody likes to have perfect credit. I like that too. But if you want to go out and look at homes, we've got to look at your credit report in order to get you pre-qualified. And we've got to look at your credit report to then take the next step to get you pre-approved. So if you're worried about your credit score, Mr. and Mrs. Client, let's talk about the other issues, because it might not be the right time for you to buy a property. And that's okay, right? It's not perfect for everybody to buy a property all the time. That's where you would want to talk to a lender. Make sure you're understanding what's going on with your personal financial situation so that we can help you, give you the best possible advice for your individual situation. So agents out there, if you get this question, you get this feedback from your client, you really want to have an in-depth conversation with them. Let me give you one last story as we're wrapping up. I had a client a number of years ago. This would have been in 2012. The real estate agent refers the client over to me. Wonderful real estate agent, very polite client. She was outstanding. We go through the application. Where do you live? Where do you work? How much money do you make? We get to the end and I say, okay, Mrs. Client, I'm going to need to ask you for your date of birth and your social security number so that I can pull your credit report. She said, oh, Joe, don't worry about it. I have terrific credit. I don't want you to pull my credit because I don't want my credit score to go down. Okay, no problem. I completely understand. Unfortunately, Mrs. Client, I cannot give you a pre-qualification letter and I cannot give you a pre-approval letter. She said, that's okay. I'm not worried about it. My credit's perfect. Okay, I understand. Reached out to the real estate agent. I said, hi, I spoke with Mrs. Client. She's outstanding. She sounds very polite, sounds very kind. You know, she says she makes great money. Unfortunately, I have not been able to verify anything and I have not been able to see her credit. And the agent said, well, how do you think it is? And I said, I don't know. I can't see it. That's kind of like asking a dentist, do you think this person has good teeth, but you can't look in their mouth? I don't know. All right. Very nice client, very nice agent. But I said, unfortunately, I can't give you a pre-qualification letter. Well, there was a lot of homes on the market at the time. They went out and looked at homes on Saturday and Sunday for 7 weeks in a row. 14 days that they went out and looked at homes. No problem. That's part of being a real estate agent. That's part of shopping for homes. They were looking at anywhere from 5 to 10 homes per day. Sunday afternoon, 7 weeks later, they called up. Okay, Joe, we found the house. We're ready to put in an offer. We need the pre-qualification letter. I said, okay, great. I'm happy to help. I have to have your social security number and your date of birth so that I can pull your credit. She gave me the information, pulled her credit, and she had a bankruptcy 6 months prior. We didn't talk about this a lot because we really spoke mostly about minimum credit score, but having a bankruptcy 6 months prior is going to disqualify you from any one of the 5 loan programs that we just spoke about. So unfortunately, I had to tell her, you know what, Mrs. Client, I'm really sorry. Based on your bankruptcy 6 months prior, you cannot qualify for a new loan right now. And she said, but Joe, I have this much money down and I have all of these other things. And I said, I understand that, but you just had a bankruptcy. You have to wait the minimum waiting periods, which is 2 years for FHA and 4 years for a conventional loan. And it's only been 6 months since your bankruptcy. Unfortunately, I cannot offer you a new loan. And she was really upset. And I felt very sad for her, but I said, unfortunately, I cannot get you a new loan. This is the first opportunity I've had to see your credit. You can't buy a new house right now. And she said, okay. And we ended the phone call. And I reached out to the real estate agent and said, you know what, I'm really sorry. Now that she's let me pull her credit, she had a bankruptcy 6 months prior. And unfortunately, the buyer does not qualify for a new loan. And the real estate agent was very sad. And she said, gosh, that's really sad. Is there anything that we can do? And I said, well, no, right now, no, there's not anything that you can do other than wait 6 months. And the real estate agent was just super distraught. And she said, Joe, I was counting on this commission. I needed this commission to pay my bills and this payment and that payment. And I said, I completely understand that. But unfortunately, we were not able to view the client's credit until today. And I gave you a decision within 15 minutes that unfortunately she doesn't qualify. The reason I'm telling you that story is if you're a newer agent and you have somebody that's worried about pulling their credit, it doesn't hurt to show them one property, maybe two, and spend a little bit of time with them, but don't get too far down the road without being sure that they can buy a property. I would describe that as, hey, I want to go to Walmart because I need to buy some new clothes, but I don't know if I've got $20 in my pocket or if I have $1,000 in my pocket. That's what that pre-approval letter is telling you. That's telling you how much money you've got in your pocket when you're wanting to go buy that property. Now, I got a really good question here. Let's take a look here. Does Castle & Cooke Mortgage offer any non-QM loans? Yes, absolutely we do. So for those of you out there that are not familiar, non-QM is going to be alternative financing that would solve this problem of the bankruptcy. So we actually have some plans now that allow you to qualify with less than that 2 years since a bankruptcy. But this particular story, this was back in 2012 before non-QM loans had been invented. But yes, we absolutely do have all sorts of alternative financing that we can offer now. This is outside of something that happens a lot, but I would be happy to chat with you individually about that. Non-QM is a great option for folks that don't qualify for any one of the 5 transactions that we just looked at or 5 different loan types. So please feel free to reach out to me individually. Be happy to go through that with you. All right, guys, as we are wrapping up here, thank you so much for joining me. Really appreciate the questions. Hope that everybody got some great information. Very last thing I want to talk about is what we do here at Castle & Cooke Mortgage. Again, my name is Joe Massey. I'm the team leader here at Team Massey at Castle & Cooke Mortgage. We do conventional loans, FHA loans, jumbo loans, VA, USDA, also investor cash flow loans, which we did not even talk about today because I've got a whole class on that. And great question from Gabe. And we do, whoops, that's bad handwriting. And we do non-QM loans. All right. So we can help you with just about any type of permanent residential financing that you might need for your primary residence, second homes, or investment properties. So all 3 of the property types that we spoke about, we can help you with those. We can help on purchase loans, refinances, as well as HELOCs, home equity lines of credit, as well as fixed rate second mortgages. So just about any type of permanent residential financing, that's what we do here at Castle & Cooke Mortgage. And why should you use us? If you're a real estate agent and you say, hey, you know what, Joe, I really appreciate the information, but why should I work with you? Number one, we have our 8-day rush service. All right. Even if you do not do a rush with us, our average time frame from application to full approval and clear to close is 21 days. Industry average right now is 49. Think about that for a second. If you work with the average lender in the industry, it takes 49 days to go from application to clear to close. Our average is 21 days. Our 100% pre-approval record. If we give your client a pre-approval, that loan will close. As long as I've been doing this, I have never given a client a pre-approval and then called them at a later date and said, I'm sorry, you are no longer pre-approved. All right. Next, real estate agents, if you've not heard of HomeBot, this is our set it and forget it database. Really, really cool way for you to keep in touch with your clients. Really a cool way for you to maintain contact with your database. We also have e-flyers and single property websites for all of your listings. So this is really cool. It's a service that we offer through a couple of our partners. And we are offering classes, of course, which is why you guys joined me today in person and now focusing a lot online. So hopefully this has been useful for you. If you have questions, please feel free, call, text, email. All of my information is over here on the left. You can reach me at 303-809-7769. Of course, you can email me, jmassey@castlecookmortgage.com. You can reach our website with all of our blog articles, videos, and home buying information, loansbyjoemassey.com. And please like, share, follow Facebook, Instagram, LinkedIn, TikTok at jmasseylending.com. The very last thing, this QR code over here on the side, this is our mortgage calculator, which you can install on your iPhone or Android phone, which will allow you to calculate payments, allows you to scan documents in and send them to us. It's really, really handy application. If you have any other mortgage questions, please call, text, email, send a carrier pigeon, however you want to get in touch. Would love to spend time with you. Love talking about mortgages. And thank you so much for joining me today. Everybody have a fantastic day, and I will talk with you again soon.